All right, what's going on, guys? Midwest Multifamily Podcast with Gwyeth Smith here. Gwyeth, thanks for coming on. It's appreciate you making time.
Man, anytime for you.
Awesome. Well, it's been I guess we met about over a year ago now, and definitely been a friend, a mentor, tons of input, especially in the Midwest market. So we certainly appreciate you for that, and hope that an opportunity in the near future will work out and something will stick. So if you don't mind jumping in, I actually think this is kind of interesting because I don't even really know your initial backstory of getting into real estate. So if you don't mind kind of starting there with how you got started and where you guys are kind of at now.
Yeah, sure. So I was in equities. I was in like the stock world way back when, back in like the late 90s and whatnot. And I've always had some sort of investing background. But then I got into allied health and I was in prosthetics for a few years. And when I was in prosthetics, I was looking for something to supplement income, something to what I really wanted was that if the shit hit the fan, so to speak, in my job, and for whatever reason, something happened where it wasn't there anymore. I wanted to be able to slide into something kind of seamlessly without having to just do a complete pivot and start from the ground up. So, I again with having the investing background, I decided to purchase a few rental properties. I'm in New York. My wife is originally from Pittsburgh, and we know and like the market, so we bought a duplex in, I think it was 2017 or 16, somewhere around there. And very soon thereafter, we bought a fourplex. So we bought a couple properties in Pittsburgh. They were going well. I started getting more and more involved with, figuring out how to build a portfolio and what I really wanted to do. So around the same time, I had made a couple limited partnership investments. Those were in Dallas, like the DFW market. And I started just networking with people like you and others, and found this 13 unit in Pittsburgh and got a partner, and we took this thing down together. And that was basically the start of it. And then how things grew in the networking and the groups that I had joined, I ultimately co-sponsored a few larger deals, larger syndications, and got my feet wet being on the general partnership side of those type deals. Ended up finding my core team back then as well, and back in 2019 we purchased a 42 unit building in southern Indiana, which is how we got a little bit more into that Midwest market. And then it was organic. It was organic growth. Our deals got a little bit bigger. Our first real syndication that we did as a team, where we were the lead, we actually just went full cycle on that last year, and that was those 194 units in Columbus. So ultimately that's where it started and how it kind of grew to where it is.
Awesome. Yeah, it's interesting to hear. Wasn't sure of kind of how you got into it all. So as far as getting to where you've gotten now, you already hit on a couple things, but habits or things that you implemented to kind of build that momentum. I know you hit on networking and constantly interacting with other investors. Obviously played a big part in building your team and scaling. Any other things that stand out to you that you would mention?
Yeah, I think you hit on it with building out that team. So just being around the right people and just putting the right people on your team. When we had looked at that 42 unit property, it was me and my partner Mike, and we originally saw it, and then we proposed it to two other guys, Chris and Duran, and that's how we all came together. And we came together basically saying like, hey, let's do this as a one-off deal. If we work well together, maybe we look to build something and grow from here. If it doesn't work out for us, then it's fine. It's a one-off deal. We'll stay in the deal, and it'll be what it'll be. And those things just, they worked out. So we were able to kind of create the core team, and that's evolved over time with what roles people employ and what the involvement is for everybody. But yeah, getting yourself around those people and just, getting next to the right people to actually kind of do deals with. I mean, me and you have been looking for a while together, right? And we got close on a couple, and I'm confident that we'll find something, and that I feel like when we do, it'll be a it'll be a fun thing to work with you, just because how we've gotten to know one another in the year and a half, 2 years that we have.
Absolutely, yeah. Now, a couple questions, personal things that we're working on, but something that I think you might have some input on. Real estate, obviously, being a sporadic thing, deal flow, ups and downs, and market conditions. I know you mentioned implementing traction to kind of forecast a longer term time horizon to then maybe reverse engineer action steps and what you need to be doing on an annual or monthly basis. How have you kind of determined like where you guys want to go, and what are you doing now to make it happen?
Yeah, so we did implement traction, and that started with reading the book. We tried to self-implement. It's tough. It's tough getting everybody to buy in. And there were iterations of what that looked like. So if you know traction, you do traction. You really start with your core values, and even for us, those have evolved over time. Um, and you're basically all your decisions should be made with those core values in mind, like hiring the right people, firing the wrong people, getting the right people in the right seats, and even within your team. So we got to the point where I think we struggled enough trying to do it ourselves that we actually hired an implementer, and that implementer really helped us along and allowed us to see where we were coming short, see where our vision was lacking, see where we needed to put a little bit more time and effort to gain some clarity, whether it be on a 10-year picture, a 3-year picture, or an annual picture, but like what your main issues are as a company, and kind of set those as you know as the things that you need to focus on and move forward to kind of correct, and also just start implementing the operational systems of traction.
Absolutely. If you don't mind sharing, where I guess, or how big are you guys kind of projecting and looking and on like that 10-year time horizon?
Yeah, so we recently revamped quite a bit. Kind of went back to the drawing board, so to speak. So kind of picturing the 10-year picture now. What we're looking to build is basically like a synergy of companies. So the core of that company is going to be a real estate portfolio, and offshoots of that is going to be how we operate it, meaning on the management side. If we hire maintenance, construction, if we have different arms, if we have like a holdings arm, a construction arm, a management arm, all kind of flowing into the portfolio itself, all adding value to that portfolio in ways that maybe a third-party management company can't, or third-party vendors can't. But also then, those arms that we're creating for this kind of big picture is also profiting off of that portfolio. So they work together, each one kind of supporting and sustaining the other, but all for the greater good of what we're calling that core of the portfolio.
Gotcha. Definitely interesting, and yeah, certainly, the way that they can feed into each other is something we've thought about too, and I think it's inevitable. Maybe not in the near future, but just to have the finger on what's truly going on in the business and in all aspects is certainly important. To kind of change gears a little bit and talk about markets, you have obviously invested in multiple markets, LP'd in others, and obviously we've looked at a lot of stuff in Columbus, you own in Southern Indiana, Pittsburgh. What's kind of the attractiveness, or what are the things that you look for? How have you identified those markets? Why do you like them? Maybe share some of those things.
Yeah, so Pittsburgh was my wife. We actually knew it. And if you kind of look on a map, there's like a 3-hour drive from Pittsburgh to Columbus, and then Columbus to Indiana. So like we kind of consider that our triangle. Um, Columbus was a market when I was first starting out. I just, I liked it. They have the big university there. It's the capital of Ohio. It's not like some of the other markets in Ohio. And obviously, since we kind of chose it as a market, there's been some significant growth and significant business coming into that market. So that's why we like it. I mean, the fact that they're all, kind of Midwestern cities that that hit the mark is another appealing factor to us. We looked in the Texases and in Houston, for instance, and Florida. The competition was a lot, and we weren't we weren't necessarily seeing, I shouldn't say the value, but it was hard for us to kind of get in front of anybody. Um, it was hard for us to get deals to pencil out without really relying on the growth that they had experienced and continue to experience. But for us, it wasn't. We just couldn't compete. We didn't have any competitive advantages. We thought it was going to cost us more to operate than it would some of those bigger players in those markets. So really just coming in at a disadvantage. So we're in the markets that we're in because we have the presences there. We have the resources there. We'd be open to other markets, but one thing that we talk about is that we wouldn't just hop into another market without somebody, some trusted person in that market to be part of the team.
Definitely, yeah, super important. And we've started to kind of test that out even within Ohio, but more of like a virtual market to Ethan, northwest of Columbus, and having someone there is certainly important to, kind of keep tabs on things. Specifically looking at some of those maybe hotter, more competitive markets that you mentioned, Florida, Texas, where maybe they do see a little bit more appreciation, but they also have steeper ups and downs. Is there anything that you find attractive with, like, personally, I can say we feel like deals cash flow better in the Midwest, but maybe we don't get the same swings and potential exit opportunities on that upper end. I'm curious if you feel that way, or if you think in some Midwest markets, you still get those upsides, or what your thoughts are there.
Yeah, I think I agree with that. I think obviously cash flow is safer. It's a safer bet than relying on something else, whether that be organic rent growth or, something. But I always feel like in situations like that, you need to be really well capitalized in your deal, because one thing that goes wrong can just, set you back quite a bit. Not that it can't in, like Midwestern markets, but if you have the cash flow to sustain that, like if you have a new roof that you have to put on for $20,000, but that property is ultimately cash flowing, 17,000 a month, okay, let's withhold distributions for, couple months, month and a half, get the new roof put on, as opposed to, hey, we got to go find some capital to do this, or whatever it is, if you don't have it.
Definitely, and that's something Ethan and I are certainly learning, even in our personal portfolio, is that cash flow is really just that buffer to never be forced to sell in unfavorable market conditions. And we're really making money on the equity creation, the forced value add, and those aspects, whether we leverage them, in the future via sale, refinance. And so it's definitely interesting to see how cash flow can certainly get eaten up very quickly by unanticipated things that no underwriting tool is going to tell you. So that's definitely been a learning experience for
Yeah.
us. I know you mentioned a couple of things. If you were to go back, start over, do it all again, that you might do differently, or give advice to yourself when you were starting. But is there anything that really stands out that you think is important?
Vetting the people that you get into business with, I think is important. How you do that, I wish I had a great answer for you. Trusting your gut is also important. If you're looking at a deal, and I want to say in the beginning, you're really gung ho to close a deal, right? So you might look the other way, or you might justify in your head why, oh, this is okay. Like you get an inspection report that says, all your HVACs are at the end of their life. Is it worth it to continue or not? So just have that mentality of looking at things, and looking at projects, and looking at things every day, and having it be a fresh look, because things change as you go through diligence. And don't try to just get a deal to get a deal. Try to get the right one.
Definitely, and I think we did the same thing, where even on smaller projects we just, holding costs will be 5,000, and merely they're 15 to 20, or whatever it is, just to get it done. And just from a lack of initial deal flow when you're first starting, I think probably aids in our, yes man to everything that comes our way. As far as maybe combating that a little bit, but starting the right way, you obviously, were able to LP in some deals early on, and probably I'm thinking that likely helped you in understanding the overall, how things go and underwriting and those things. Do you think that's a thing you would recommend to people getting started if they have a little bit of capital they could throw in a deal?
Absolutely. I mean, it worked out. It worked out really well for me, and I mean, I'm still in those deals. Neither of those, I'm LP'd in 3 deals, and none of those have gone full cycle just yet. But I mean, the first 2 that I LP'd in, I found the operators of the deal that I was a general sponsor on because their deal was right next door to one I was LP in, and a conversation started, and I knew as an LP what we were getting for rents. You know, you get the financials on a monthly basis, so I was able to look at their projections and see how our actuals were, and basically compare. And it was that information, that knowledge, which both gave me comfort in their deal as well as them kind of getting some comfort in me because I was bringing, some information, just to the table to see like, hey, is this achievable? So I mean, and what I'm really saying here is that like me LPing in a deal was a direct, or me GPing a deal was a direct result of me LPing in a deal.
Right.
It was a 1-to-1, 100% relationship.
Yeah, no, that makes a lot of sense. Now, maybe on the other end, from deals that you've been a part of where maybe people want to get involved but don't necessarily have capital they can tie up, is there any other ways that you've seen people successfully learn from operators, get involved without necessarily bringing that capital?
Capital is important. Like I won't lie, it's tough to to basically sit back and say like, hey, what can I do? I feel like you need to take the initiative to just do something, whatever that may be. Um, but it's a tough one for me to answer because at the end of the day, capital's extremely important, and your investors want to see you putting capital into your deals, which we do. So it's a tough one to answer.
Definitely. And yeah, I don't know if you'd fully agree with this, but something that I've noticed even from just attending local real estate meetups is a lot of people work 50, 60-hour weeks and think they're going to be able to jump in and, operate a big syndication or even just a JV, whatever it is. And coming from that lack of capital place, which is exactly where Ethan and I started, and the only reason it's worked for us is because we were sourcing the deals, which I think's kind of maybe the one caveat to what you're saying is if you can hunt down opportunities, but maybe you don't have the capital, you can kind of build some of that team around you and bring people in. You might not be getting majority equity, but it's definitely worth something. And going back to kind of that other point, it might just be like an earning potential thing where instead of trying to build out while you've got a full-time job, this real estate thing, the way you kind of went about it, being the LP versus trying to jump into a GP, figure things out, build the parachute on the way down, obviously can be a little bit risky, especially with just the overall lack of time you probably had in the beginning. So that's kind of the advice that I usually tell to people, especially people that might have decent jobs and they want to jump in. They know they don't want to stay at their job, but maybe the safer route is to kind of passively invest, get your feet wet that way.
Yep. And yeah, and to also when you're passively investing, you're getting a majority of the deal, right? Anyways, so we kind of say it all the time with some of that syndicate. It's a lot of work. I mean, it's a lot, and you're giving a lot of the deal away, and rightfully so, right? Because that's where the majority of the money is coming from. Ideally, we'd love to, as we build these things out and we build that portfolio out, and like I said, there can be a syndication arm, there can be a holdings arm. Like we want to see that holdings arm grow.
Definitely, and I was actually gonna bring that up with you. Ethan and I have gone back and forth on this now. Getting our feet wet in a couple of these syndications, seeing the risk on maybe the deal size, answering to investors, the documentation involved, all of those things, and then how much our personal equity stake really is versus us buying a 10-unit complex, maintaining 100% equity, not being forced to sell in 3 to 5 years. So it sounds like you're obviously thinking the same thing there. Do you think, I guess, what are some of the maybe pros and cons that might not be so obvious between the two options where taking down the larger project that you couldn't have personally bought versus maintaining equity in smaller properties?
So I think those larger projects can lead to other projects. They can lead to certain synergies. But like you said, you're a little bit handcuffed on a timeline. You're handcuffed to expectations that were presented on the front end. We've had projects where we ultimately, kind of had buyer's remorse in that, not on the project, but how we structured it. Because a deal ends up being a deal that you say, man, this could be a long-term generational wealth builder. It's such a great project that, is great, but we set this expectation that we were going to sell it in 3 years. So now here you are. It's hard to change your, plan when you set that expectation if you can kind of hit that expectation. Granted, it's a different story if things go sideways and you can't, meet that expectation because of one reason or another. But to have that flexibility, to be making the decisions for yourself as opposed to for your investors, I think is one of the big differences between doing a syndication or even a JV or, just kind of holding it within house.
Yeah, absolutely. Another question that I know we've talked about quite a bit, but more on kind of the debt side, not knowing where rates are going right now. Banks kind of shaky right now as well. One thing we're doing on any of our value add projects is purchasing with an interest only period that rolls to an amortization schedule, just to kind of not be forced to refinance and bridge debt on a 1, 2, 3 year time horizon. Any other, I guess, sensitivity things that you're implementing that you think are smart given the market conditions right now?
Yeah, I think on the debt side in particular, just always being in tune with where things are, right? Because those things, they change so regularly. I remember last year and maybe for the last 2 years, bank debt was the way to go. It was giving you the best terms, it was giving you the best leverage, it was giving you the best rates. You can wrap construction costs into, some of those deals. And it seemed like a really good product, and it was a really good product. Now you compare that to the agency side of things, where that seems to be more competitive right now from a rate perspective. In particular, you're not really going to get the construction funding in there, but you're going to pay for construction funding anywhere right now, between 7, 8%. So, what's cheaper, the cost of equity then, or the cost of that debt? So you just have to be in tune with it, because like I said, last year it was one thing. This year right now it's a little bit different. There's other options out there, whether it's bringing more equity to the table, and if you can find that, and at what cost that would come at. So just knowing all that, and then from a sensitivity standpoint, I mean, I think you have to continue to, not to say that there's a crystal ball, but what are the possibilities of just the macroeconomic environment and also the microeconomic environment in your markets. But what happens if the jobs market starts to turn? What happens if we start to see cracks there? Are we going to then have higher delinquencies? Are people not going to be able to afford the rents anymore because people living in the houses can't afford to buy another house, whether it's because of their interest rates or this and the other. So there's almost like a little bit of a static environment right now, where people aren't necessarily moving. Job market's still good, we're still good, but if those cracks come along, what does that look like, and what does that look like to your deal and your projections? So it's a tough thing to do, because I think there's still buyers out there who are going to buy under these assumptions of unicorns and rainbows, and that's who's ultimately going to get the deal. So to be competitive to get the deal, you almost have to do that. So the alternative is, you do maybe what you're doing, kind of like direct to seller, try to find some good deals that way. But I think you need to look at those sensitivities, specifically a slowdown in rent growth, negative rent growth. What does that do to your projections? Increase in vacancy, increase in delinquency. Like, what are these things doing to your deal, your valuation at the end of the day?
Absolutely. Yeah, that no, all great inputs there. On I don't know the exact stat that I read, but it was pertaining to the amount of multifamily specific loans that are out on bridge debt due, I believe this year or maybe in the next 12 months. What do you think happens in the space when those loans come due and they can't refinance at 4.5% that they projected maybe a year, 2 years ago? Yeah, I guess how do you think that plays out?
I think that's where you're going to see some forced sales. You're starting to see it already with, if you subscribe to any of the brokerages, and you get listings. I mean, you're seeing price changes all the time these days. Either price changes, or the other one is like, oh, look how much the financials improved in 1 month. Like, first time ever this property's hit 200K collections.
Right.
So, yeah. But I think you might see some forced sales, and you know, or things going to be sitting until those forced capital events come up. So
Definitely. Do you, um, you know, foresee or anticipate any, changes in the lending? I know even right now, like you mentioned the agency debt being a little bit more attractive on the rate side, but I know they're kind of pulling back on the leverage. Is that something that you expect to carry over to, maybe the local credit union side as well, or anything that you see coming there?
um, like I said, no crystal ball. They're everybody's rates and whatnot are based on different thing. I think the reason that the agencies are a little bit more competitive now, because they're based off the 10-year Treasury, which has come down some. So you look at SOFR, for instance, which maybe some of the banks are using as a basis, and that's, gosh, I don't know, 10 times higher than it was a couple years ago, maybe more. um, in terms of where we're going, it's hard to know. It's not just as simple as the Fed is hiking the Fed funds rate, and then it's going to pause and it's going to go back down. There's other factors that affect the basis to what your banks, credit unions, and agencies are actually using to price their products.
Absolutely. Yeah, the last thing I kind of wanted to hit on with you, and this has obviously been something recent that you've been helping and providing some tools with, but specifically what it means to asset manage a property and how important that is to not only compare to your initial projections and get a little bit of clarity on where you were right, where you were wrong. Super important for where are things standing with that deal, but also underwriting for the future. How important do you think that's been in you guys taking on opportunities and being confident in your numbers with upcoming deals and underwriting?
Yeah, that's that's the challenge right there, right? Is um, operating the deals effectively. Because if you know where you can operate, I mean that's what's getting plugged into your underwriting models, and that's going to tell you what you can afford to buy. Because if I can operate a deal at only, call it like 6,000 in expenses a unit, whereas this guy over here has teams built out and he can operate it at 55 a unit, he's obviously going to be able to pay a higher price, and I'm going to pay, and he's obviously going to get the deal. In terms of like asset management and the importance of it, it's super important, but it's also, I mean, it's not the easiest thing in the world, right? We've talked about this, with your cadence calls, with your management company, like you're having decent success with it, and we would have cadence calls, and almost like things would fall on deaf ears at times, and you would come around next week and you're having the exact same conversation over and over and over again. So what we started looking into is how do we create the accountability? How do we make sure that what's said yes to on a call is actually implemented, or like, hey, we can achieve this occupancy level or this number in collections, and if you don't, then what? What do you do? What's the consequence? So, we brought some stuff in house to um, try to make that more efficient. So basically going from an asset manager to building out a property management company. Just out of necessity on a few projects. Um, so it goes hand in hand, but to effectively asset manage, if somebody's got the way to do that and hold your people who are then your property managers accountable to it, I'm all ears.
Absolutely. Yeah. I think the point of that was when people do listen to this, the point being when we initially bought properties, we thought run some direct to seller marketing, find a deal, lock it up and buy it, turn it over to property management and everything would be sunshine and rainbows from there. And a couple of years have gone by and now we're realizing, yeah, that's certainly not the case and there's definitely work to be done after purchase and even after stabilization. So, yeah, super important. But Gwyeth, appreciate you coming on here, sharing a ton of solid information. Obviously, a ton more outside of these calls as well. Where can people connect with you, reach out to you, and get in contact?
I'd say email is probably the best way. So my first name, Gwyeth at rustic-capital.com, and go from there. I wish I could say I'm on social media more than I am, but
No worries. I'll throw that email in the show notes. But thank you again for coming on here and making time. We appreciate it.
man, anytime. Thank you.